In today's video, I'm going to be discussing the banking system and how it's about to implode with $517 billion of losses currently on their books and 63 lenders that are about to go bankrupt. I have all the details for you here in the video. Let's get into it and discuss what's going on. All right, now first off, when you think of the banking system, what do you generally think about? Some big fancy building on a street corner that takes all of your hard-earned dollars? Well, yeah, that's pretty much the case, but there's a lot more to the picture than just that. Yes, they are big fancy buildings most of the time. Yes, they do take your hard-earned dollars, but they take that money and they lend it out immediately. So they take in money through deposits and then they turn around and they lend all that money out to people like us who maybe want to buy a car or get a personal loan or maybe buy a house or whatever we're borrowing money for. They take all those deposits they're getting and they lend it back out and they charge interest rates that are higher than what they're actually paying out through interest that they're paying to their depositors. So any money sitting on the balance sheet of a bank is actually a liability to the bank. Why? Because they're paying out interest to people like us who may have a little bit of money sitting in a savings account, some kind of interest-bearing account, something like that. They have to send that money out immediately because otherwise it's a liability. So therefore, they need to re-lend that money and collect interest and collect money income off of that money so they can pay out the interest as in the liabilities of it. But here's the interesting part about it. Just got done reading a report on this, and this is not a good situation, okay? We saw things like this happen back in about 2007, 2008, 2009, when we saw a lot of big banks failing at the time, and we saw the huge implosion of the real estate, of the subprime, a bust back then, and a bunch of big banks going under, things like this. Kind of the same situation that we're seeing play out right now. But I just got done reading this information about this and researching it, and I wanted to share with you really quickly. As of right now, banks are sitting on, or I should say the banking system right now, sitting on $517 billion of unrealized losses on their balance sheets right now, most of which is tied up in real estate. Now, the key word that I want to point out really quickly in what I just said there is unrealized losses. Now, it's an unrealized loss, okay? Until they realize that, it is not a real loss until it's actually realized. However, it's still on their balance sheet. This is $517 billion, $500 billion that is in unrealized losses right now on their balance sheet. Now, that is very concerning in a number of different ways. Now, you might be wondering, what is unrealized? I don't really know what that means. Can you explain? Let me explain this really quickly, okay? Let me use a stock analogy really quickly, okay? Let's just say that you buy a stock for $10 a share and you buy one share, okay? So you buy one share at $10 and then all of a sudden the price drops immediately down to $5. You've just unrealized a $5 loss on that. In other words, until you sell that stock, you've not realized that loss, okay? Now, if you bought it at 10, it goes down to 5. Yes, you're technically sitting on a $5 loss on that one share. However, you have not sold the share yet, so it's not realized. It's an unrealized loss. However, if you sell your one share now, you've actually realized that $5 loss on that one share. Does that kind of make sense? Same thing goes with a game. Let's just say that you buy the share at $10, one share, and it goes up to $15 a share. You now have an unrealized profit of $5. Not bad, right? It's unrealized because you've not sold yet. However, now you sell. You say, let's ring the cash register, let's sell my one share, and you sell your one share at $15. You have realized a $5 profit in this case. A capital gain of $5 is what you got there, right? You see the point? Same situation here. So that's what I'm saying. It's an unrealized loss. In other words, they haven't exited their positions yet, so therefore, it's not technically a real loss yet. It's still a paper loss. It's a paper loss of $500 billion, okay? That's a huge loss. That's a lot of money that is potentially sitting out there in the form of an unrealized loss. But the situation is, these banks are sitting on these unrealized losses. Now, the problem is, if they're looking for liquidity, as in, they need liquid cash, things like this. This is a major problem. That's a lot of unrealized losses that are sitting there that potentially need to be liquidated at some point to raise capital. That's a bad situation to be in. You never want to be in a situation sitting on that much of an unrealized loss. I mean, an unrealized loss of a little bit is fine. That happens all the time. Not a big deal whatsoever. But when we're talking about $500 billion, that's a ton of money, okay? I don't care who you are. $500 billion is a ton of money, right? That's a lot of money to be sitting on. Now, here's what's interesting about it. They also found that 63 lenders across the country right now, are basically at the point of potential insolvency, potential bankruptcy, okay? Insolvency is literally just a really nice and, a nice fancy and a nice eloquent way of saying, well, you're basically bankrupt. That's basically all it is, okay? Insolvency is just basically saying you're out of money, you're bankrupt, you've got nothing left, you're going down, that's it, okay? It's game over. That's basically what they're saying here, okay? So they're basically saying 63 lenders. Now, considering the thousands upon thousands and thousands of banks and financial institutions all across the country, 63, yeah, it's a very small number. However, think of it. If you think 63, we're not talking like 63 locations, we're talking 63 brands. Each brand could have 100 locations, 1,000 locations. They could have thousands of locations technically across the entire country, right? So yes, it's 63 different brands of banking, but they could have thousands and thousands and thousands of locations between these 63 that are potentially looking at insolvency. Bad situation again, right? Now here's what we're seeing. Earlier this year, we've already seen a couple bank failures so far this year. Not that many. We've seen a couple big banks go down. That's not like unheard of, right? We see banks and financial institutions failing all the time. Not a big deal, right? But remember last year, right, the beginning of last year as well, we saw Silicon Valley Bank. That went belly up in the matter of no time at all. All of a sudden, one day, it's like, Silicon Valley went down. What happened? And then we saw Signature Bank shortly thereafter went under as well, right? Not a good situation. Some big reputable banks here, been around a very long time. Boom, they're gone, right? And then what happens to these guys? Do they just disappear and all those depositors lose their money? No, okay, they're FDIC insured and they get bailed out with taxpayer dollars. It happened years ago. It happened again last year. It happens again this year. They never tell us the truth on this. They always say, oh no, it's not taxpayer dollars. Yeah, right, it's taxpayer dollars that are bailing these big banks out. But my point is, at the same time, a lot of these smaller banks, these smaller institutions, these smaller banks and branches and things like this, a lot of the times, what happens to them? When they're facing a potential insolvency situation, what happens? They get gobbled up by the big guys, right? The big banks, the ones that have hundreds of billions of dollars, have tons and tons of money. The biggest banks in the countries, a lot of times they're called too big to fail. You probably heard that at some point, right? What happens is these big guys who have tons and tons of money, virtually unlimited amounts of money, they come in, they gobble up the little guys, and then they just kind of take over, right? So that is the kind of the situation that's going on. But sometimes they are allowed to fail, and that's it, game over, right? Now here's the thing as well. A lot of times it's easy to think like, a bank, how could a bank ever possibly fail? They have all the money, right? They're holding all the money. A bank is a business. A bank is just like any other business. A bank can fail just as easily as a sandwich shop. A bank can fail just as easily as a gas station. A bank can fail just as easily as a restaurant, okay? Now, obviously, these are all in very different sectors, but a bank is a business. They run just like every other business. Yes, they do have a lot more regulation. They have a lot more rules and laws they need to abide by, but at the end of the day, it's a business. They are in business for profit, right? If they do not have people coming in through the door, depositing their hard-earned dollars in their vaults and in their fancy products, their savings accounts, their checking accounts, their CDs, all kinds of different things that they get like this, if they don't have depositors coming in the door to make those deposits, they've got no money to lend out. If they have no money to lend out, well then guess what? They don't have a business. It's called no business. That's literally what it comes down to, right? So banks are literally in the business of collecting money from people like you and me who maybe have $5 to our name. We deposit it into an account. They flip it around. They send it out in the form of loans, in auto loans, home loans. Again, the list goes on, personal loans, lines of credit, whatever, you name it, any kind of loan, anything that involves borrowing money. They flip that money around and they lend it back out because they have to get it off their balance sheet because it's a liability to them to pay out in interest. So again, when I say that, think of it this way, okay? Let's just say that your bank right now is paying, 3% on a savings account. Maybe that's high, maybe that's low. It depends on where you're banking. But let's just say that your bank is paying 3% interest on a savings account right now, okay? That's 3% interest they have to pay out. That's why it's a liability. But if they flip around and they send that money out in the form of a loan and they charge 7.5% on a mortgage, now guess what? They're collecting 7.5% interest on a mortgage that they've took money from depositors and sent it out in the form of a loan, and then they're paying it out to depositors that have money sitting in savings accounts. any money that might be sitting there or that is phantomly sitting there, it's actually not sitting there. It's actually just a number displayed on a screen. Things like this, it's actually not there. It's been lent out, right? It's just a number. It's a placeholder. But that money that's potentially sitting there, now they're paying you 3%. So they're paying you 3% on the money that you've gave them that they're actually lending out at 7.5%. You see how the game is played? Yeah, that's called business, okay? That's called a business, not a charity, right? So anyway, but this is what's going on here, and there are a lot of people out there, a lot of banks that are at risk right now of insolvency, potential bankruptcy, and about $517 billion sitting out there in unrealized losses, okay? Now again, it might be unrealized, it might not be a big deal now. I get it, unrealized, not that big of a deal. We can sit in the hole for a while now, not a big deal until it's realized, okay? At some point, they may be forced to start realizing some of these losses, and that's going to take them down fast, okay? It's going to be like the ship taking on water super fast. You got to do something, right? Bail. Get out, right? So anyway, I'm going to continue watching. This is going to be a big thing going forward here. If we continue to see a lot of this going forward here, and if we start to see banks going down, dropping like flies, get ready. If that happens, the whole economy is going down, okay? Just get ready on this. I don't want to sit here and scare anybody. I don't want to sit here and fearmonger. I don't want to do that at all, but my point is, if we start to see banking going down, get ready. The rest of the economy is going to follow, and it's going to be ugly, right? But is that good or bad? Depends how you look at it. As I've said before in other videos, a recession is a reset. It's a big old reset button, okay? It's not necessarily a bad thing, right? So anyway, purges the weak hands, and it brings, sanity back into the markets, and it brings stability back into the economy as well. It's not a bad thing. A recession is not a bad thing. A lot of people say it's all this bad thing, all the sky's falling. I happen to look at it as a recession is not necessarily a bad thing, okay? It's going to reset a lot of things for us. It's going to start us back out at zero. It's going to start us back out in a good position so that we can excel from there, okay? Make sense? Anyway, let's leave it at that for now. I hope this helps you. Please subscribe down below if you haven't done so yet. Share the video with your friends on social media. There's a share button right down below. Thank you. Otherwise, check out any of the videos here on the channel, the thousands in the video library. Those I've hand-selected for you down below in the description at the top of the comment section. And until next time, enjoy your day. Check out one of those videos here on the screen as well, popping up right now. And I'll see you again soon in the next